August 5th, 2024. A date that will forever be etched in the annals of financial history. A date that sent chills down the spines of investors worldwide. Black Monday. The day when the financial world was turned upside down. It was a day when the global stock market went into a freefall, wiping out trillions of dollars in wealth. The sheer magnitude of the losses was staggering, leaving even the most seasoned investors in a state of shock. The tech-heavy NASDAQ, the bellwether of the market, plunged by a record 12%, its biggest single-day drop in history. This unprecedented decline sent ripples across the financial world, causing widespread panic and uncertainty. The Dow Jones Industrial Average and the S&P 500 weren't spared either, plummeting by 9% and 11% respectively. The synchronized decline of these major indices underscored the severity of the situation. Panic gripped the markets as investors scrambled to sell their holdings, fearing a repeat of the 2008 financial crisis. The trading floors were a frenzy of activity, with traders desperately trying to mitigate their losses. This wasn't just another market correction, it was a seismic event that shook the very foundations of the financial system. It was a full-blown crash, a stark reminder of the inherent volatility and unpredictability of the financial markets. The red arrows and plummeting graphs were a visual representation of the fear and uncertainty that gripped the world. Black Monday 2.0, as it came to be known, served as a wake-up call for investors, many of whom had become complacent during the long bull market that preceded the crash. The sudden and dramatic downturn was a harsh reminder that markets can turn on a dime. The events of that day left many questioning their investment strategies and seeking answers. Financial advisors were inundated with calls from worried clients, all looking for guidance in the face of uncertainty. What caused this sudden and dramatic downturn? Was it a result of economic fundamentals, or were there other factors at play? Analysts and experts began to dissect the events leading up to the crash, searching for clues and explanations. What did it mean for the future of the markets? The implications of Black Monday 2.0 were far-reaching, with potential long-term effects on investor behavior and market dynamics. And most importantly, how could investors protect themselves from such devastating losses in the future? The search for answers led to a renewed focus on risk management and diversification strategies. This essay will delve into the events leading up to Black Monday 2.0, analyze its immediate and long-term implications, and provide actionable strategies for investors to navigate the turbulent waters of the market. By understanding the causes and consequences of this historic event, investors can better prepare for the uncertainties that lie ahead. The catastrophic events of Black Monday weren't a bolt from the blue. They were the culmination of a series of overlooked warning signs and ignored economic red flags. In hindsight, there were ample warning signs, economic red flags that were largely ignored or dismissed by market participants. These indicators were not just subtle hints, but glaring signals that something was amiss in the financial markets. The global economy had been walking a tightrope for months, burdened by a confluence of negative factors. These factors were not isolated incidents but interconnected issues that created a precarious economic environment. Inflation, the arch-nemesis of stable economies, had been rearing its ugly head for over a year. This wasn't a sudden spike, but a gradual and persistent increase that should have set off alarm bells. The Consumer Price Index, a key measure of inflation, had been consistently exceeding the Federal Reserve's target of 2%, reaching a worrisome 5% in the months leading up to the crash. This significant deviation from the target was a clear indicator of underlying economic stress. This persistent rise in prices eroded consumer purchasing power and put pressure on businesses to raise prices, further fueling the inflationary spiral. The impact was felt across all sectors, from everyday groceries to essential services, making life more expensive for everyone. Adding fuel to the fire were the aggressive interest rate hikes by the Federal Reserve. These hikes were intended to control inflation but had far-reaching consequences. In an attempt to tame inflation, the Fed had been raising interest rates at a historic pace. This rapid increase in rates was unprecedented and created a ripple effect throughout the economy. While intended to cool down the economy and curb inflation, these rate hikes also made borrowing more expensive for businesses and consumers, potentially stifling economic growth. Higher interest rates meant higher costs for loans, mortgages, and credit, which in turn slowed down consumer spending and business investments. To top it off, geopolitical tensions, particularly in Eastern Europe and the Middle East, added another layer of uncertainty and risk to the global economic outlook. These conflicts were not just political issues but had direct economic implications, affecting global trade and market stability. These simmering conflicts disrupted supply chains, fueled energy price volatility, and dampened investor sentiment. The uncertainty created by these geopolitical issues made it difficult for businesses to plan and for investors to make informed decisions. Despite these flashing warning signs, many market participants remained overly optimistic, blinded by the allure of the long bull market. The euphoria of rising stock prices created a false sense of security, leading many to believe that the good times would never end. The belief that the market would always go up, that there would always be a soft landing, proved to be a costly illusion. Historical data and expert analysis had repeatedly shown that markets are cyclical, yet this wisdom was ignored in the face of short-term gains. Black Monday served as a brutal reminder that economic fundamentals matter, and ignoring them can have severe consequences. The crash was not just a market correction but a wake-up call to the importance of paying attention to economic indicators and understanding the broader economic context. As the market went into a tailspin on Black Monday, one sector felt the brunt of the selling pressure more than any other technology. The tech-heavy NASDAQ, home to giants like Apple, Amazon, and Microsoft, witnessed a bloodbath, plummeting by a staggering 12% in a single day. This freefall in tech stocks was a stark contrast to their meteoric rise in the years preceding the crash, where they seemed unstoppable. The tech sector, once the darling of Wall Street, had become a breeding ground for speculative excess and unchecked optimism. Fueled by easy money and the fear of missing out, investors poured billions into high-growth tech companies, many of which had yet to turn a profit. This relentless buying frenzy pushed valuations to unsustainable levels, creating a bubble ripe for bursting at any moment. Black Monday acted as the pin that pricked the tech bubble, causing widespread panic. As fear gripped the markets, investors rushed to sell their overvalued tech holdings, triggering a domino effect that sent shockwaves throughout the sector. Companies that were once considered invincible, their valuations soaring to dizzying heights, saw their stock prices plummet back down to earth. The crash exposed the fragility of the tech sector, particularly those companies with unproven business models and relying heavily on debt financing. It served as a stark reminder that even in the age of disruptive innovation, fundamentals still matter greatly. Sustainable growth, sound financials, and a clear path to profitability are crucial for long-term success in the tech industry. The immediate aftermath of Black Monday was a scene of chaos and uncertainty. Panic selling gripped the markets, wiping out trillions of dollars in wealth and leaving investors reeling. The trading floors were a cacophony of frantic activity, with brokers shouting orders and investors desperately trying to salvage their positions. The sheer speed and magnitude of the sell-off caught many off guard, leading to a sense of helplessness and despair. Retirement accounts, painstakingly built over years, were decimated. For many, the dream of a comfortable retirement seemed to vanish overnight. The impact was particularly severe for those nearing retirement age, who had little time to recover their losses. The financial security they had worked so hard to achieve was suddenly in jeopardy, causing widespread anxiety and fear. Businesses, large and small, faced a credit crunch as banks tightened their lending standards. The sudden loss of liquidity made it difficult for companies to finance their operations, leading to a wave of bankruptcies and closures. Small businesses, which often rely on short-term credit to manage cash flow, were particularly hard hit. In corporate boardrooms, executives grappled with tough decisions, trying to navigate the crisis and keep their companies afloat. The specter of recession loomed large over the global economy. The interconnected nature of modern financial markets meant that the shockwaves from Black Monday were felt around the world. Economies that were already fragile were pushed to the brink, and the fear of a prolonged downturn became a self-fulfilling prophecy as businesses and consumers alike pulled back on spending. In the short term, the crash led to a significant erosion of consumer confidence. People became more cautious with their money, worried about job security and the stability of their investments. This decline in confidence had a ripple effect throughout the economy, as reduced consumer spending led to lower revenues for businesses, which in turn led to more layoffs and further economic contraction. Fearful of further economic turmoil, consumers tightened their purse strings, leading to a slowdown in consumer spending, a key driver of economic growth. Families began to cut back on non-essential purchases, prioritizing savings and debt repayment over discretionary spending. This shift in behavior had a profound impact on sectors like retail, travel, and entertainment, which rely heavily on consumer spending. Businesses grappling with declining sales and mounting uncertainty were forced to cut costs, leading to job losses and further dampening consumer sentiment. The cycle of layoffs and reduced spending created a negative feedback loop, exacerbating the economic downturn. For many workers, the loss of a job meant not just financial hardship, but also a loss of identity and purpose. The long-term implications of Black Monday were equally profound. Investors were forced to reevaluate their risk tolerance and investment strategies. The crash shattered the illusion of a perpetually rising market and underscored the importance of being prepared for downturns. Financial advisors found themselves fielding calls from anxious clients, seeking guidance on how to protect their portfolios from future shocks. The crash forced investors to reevaluate their risk tolerance and investment strategies. Many began to question the wisdom of putting all their eggs in one basket and started to explore more diversified approaches. The idea of balancing risk and reward became a central theme in investment planning, with a greater emphasis on understanding the potential downsides of any given strategy. The buy and hold mantra, once a cornerstone of long-term investing, was called into question. Investors began to realize that a more active approach might be necessary to navigate the complexities of modern financial markets. Educational seminars and workshops on investment strategies saw a surge in attendance, as people sought to arm themselves with the knowledge needed to make informed decisions. The importance of diversification, risk management, and active portfolio management took center stage. Financial advisors emphasized the need to spread investments across different asset classes and geographic regions to mitigate risk. The concept of not putting all one's eggs in one basket became more than just a cliché. It was a fundamental principle of sound investing. The crash also served as a wake-up call for policymakers and regulators. It highlighted the vulnerabilities in the financial system and the need for more robust oversight. Governments around the world began to implement measures aimed at preventing a repeat of Black Monday, including stricter regulations on trading practices and greater transparency in financial reporting. It highlighted the need for greater financial literacy among the public, stricter regulations to prevent excessive speculation, and a more proactive approach to managing systemic risks in the global financial system. Educational initiatives aimed at improving financial literacy became more widespread, as policymakers recognized that an informed public is better equipped to make sound financial decisions. Black Monday was a painful but valuable lesson, a stark reminder that market cycles are inevitable, and preparation is key to weathering the storm and emerging stronger. The experience underscored the importance of resilience and adaptability in the face of financial adversity. Investors, businesses, and policymakers alike learned that while we cannot predict the future, we can take steps to prepare for it, ensuring that we are better equipped to handle whatever challenges may come our way.